Hi, this is Jeremy Gresham, a principal of Scaffold Partners, and today's webinar is called A Peek Under the Kimono, How Multifamily Financing Gets Done. To help me today, I'm having Dan Joseph and Josh Messier on the webinar. Hi, Dan. Hi, Josh.
Hey, Jeremy. Thanks for having us. It's good to be here.
Great. So let me first introduce. So Dan is the president of Corridor Ventures, an entrepreneurial real estate company that owns and finances, manages multi-state properties around the United States. And his responsibilities, among others, as an owner of the company, is the structuring and financing of the transactions that Corridor does. Corridor's done about 60 transactions, acquired over $650 million worth of multifamily and student housing properties, and owns about 8,100 units through the course of its history, 17, 18 years or so of doing this. Dan is also one of my partners in Scaffold Partners. Josh Messier is a managing director with Lument. He's based in New York City, and Josh is responsible for national loan origination of Fannie Mae, Freddie Mac, FHA product lines, along with some proprietary Lument product lines. Josh began his career at Lument in 2007 and has originated over $1.2 billion in transactions. Before that, Josh worked on Wall Street at Brown Brothers Harriman and at Lehman Brothers. And Lument and Corridor have been doing business together for about 10 years. For purposes of our discussion today, we've broken our topics up into three parts: creating and building the relationship, the deal itself, and then post-acquisition. So to kick things off, Josh, can you talk to us about creating and building the relationship from the lender's point of view?
Sure, and thanks again, Jeremy, for having us to be part of this webinar. Yeah, and you mentioned that our relationship with Lument and predecessor companies goes back nearly 10 years with Dan and the rest of the Corridor team, and it's kind of a funny story, but a story of perseverance on how our relationship actually, did begin. Obviously, we take relationships very seriously at Lument. In the agency lending space, the debt is a commodity, so our entire business model is built on relationships. And there was a loan that I had been pursuing, and I was able to to track down Corridor as the owner. And what I had done is, once I identified them, I figured most other lenders just will maybe robocall or just call incessantly until someone picks up the phone or offers to have a meeting. So I do business a little bit more in the personal way, and I decided to get in my car and actually I was living in New York City. I didn't even have a car. I rented a car, drove up to Avon, and basically showed up at Dan's office door, and said, "Here, I want to be your lender. I want to be your partner. I value your time. I value your relationship, and let's sit down and talk and see how we can work together." And that was a little over 10 years ago. And obviously, I must have caught Dan and his team on the right day, but we've had a productive, fruitful, and really strong partnership that's been 10 years and going, and hopefully will continue for the next 10 and beyond.
Great. Dan, can you sort of talk about when you look at lenders and what you look at and what you want, what's important to you?
Sure. And again, also thanks for putting this together, Jeremy, and thanks for having me on the call. Really there are two things. Josh is correct that an agency loan is a commodity, and it's a commodity that is offered by tens of firms that contact me on almost a daily basis, certainly a weekly basis or a monthly basis. I'm inundated with requests for conference calls and the desire to begin a relationship. And that relationship aspect is really key for me because, when you have a relationship with a bank lender, with a balance sheet lender, that's a more flexible relationship. It's a relationship where if there's a challenge or if there's a problem, you can sort of fix it by working together when there's mutual trust. When it comes to the agency loan, once you basically build an agency loan into your overall capitalization structure, that's the loan. It's there based on those terms in permanence until that loan matures. There is not a lot of flexibility for any kind of restructuring for dealing with things that might go wrong or dealing with things that might grow right when you want to recalibrate. And so Given that factor, right, the relationship is really key for me, because the relationship then extends to the challenge of solving problems or addressing, or why don't we say addressing challenges, right, and opportunities. And that's a critical thing that I look for in any relationship we begin on the lending side. And Josh knows, like, I will often call Josh and say, we have this challenge, or we have this opportunity, or we have a problem. This is where you make your money. This is where our relationship really finds a home and a future. Because if you say to me, no, sorry, we don't really have the capability for doing that, or, this is not some kind of problem that we're here to solve. We're your agency lending partner. I have a million people, again, that I can go to for that. But if Josh says, let me talk to my guys, let me talk to some relationships that we have outside the firm, and let's see if we can't put something in front of you that solves that problem or addresses that challenge and opportunity. That way they're adding value to our business. And so from the get-go, Josh has been somebody that I consider a value-added partner. And if we are doing a deal, and I typically look at every deal uniquely, Josh looks at them uniquely alongside me. And so I can say to him, here's what we're trying to solve for. And Josh will go back thoughtfully, come up with a plan for how we can address that challenge, whether it's a shorter term loan, a longer term loan, maybe bringing on some preferred equity alongside a senior loan. There are any number of ways to shake it up. And Josh's job is to come up with ideas and provide expertise to help us come up with the best financing solution for the debt side of the equation. And he does a great job of it. And I'm grateful for his work on that front, for his providing us with credibility within his firm and within particularly the Fannie Mae community. Josh has been really helpful for building our reputation and brand within those communities, and all of that stuff provides the substance for us to be able to move forward and build our business together. So again, I'm just very grateful for my relationship with Josh and all he's done to make that happen.
Terrific. Good. Okay. So let's move on to the second part of our discussion, which is the deal itself. So Dan, let's say a deal comes into you. Let's talk about, the various stages of the deal for you, and then when you're going to take it and kick it over to Josh and get it ready for Josh, how you're going to do that also as part of the deal.
Sure. So, we filter through hundreds and hundreds of deals every single year. That's sort of the big part of the filter. A lot of deals come in. We look at a lot. Most of them get thrown out. Some of them get to the next phase, which is underwriting, where we'll put a deal into a very simple cursory model based on both the numbers and the way they play out, and our criteria for wanting to move forward on a deal, whether that's market or asset type. And that becomes sort of the second level of the filter. The next stage is to go visit a property and make a decision on, is it something we want to move forward on? Before we will get to making a final offer on a property, which would mean the next stage is signing a contract, putting money down, and aggressively pursuing that deal to close, we want to know where our financing partner falls on that. We know that we can raise the equity in this marketplace, in this environment, for all the deals that we do. The question is, does a deal make sense based on the financing? And we tend to want, especially in this environment, to overlay a conservative financing structure onto every single deal that we do, because, I don't know where we are exactly in the game, but we're certainly in the 7th, 8th, or 9th inning with just a tremendous amount of aggression and capital coming into the multifamily space, pushing prices to unprecedented levels. Interest rates are very low. It's an incredibly cooperative environment, fundamentally and financially, for the multifamily space. So, we need to be very precise about everything that we do. So once we've done that initial underwriting, we bring Josh and his team in and say, give us some financing options. And we'll have back and forth conversation about what that might look like. Are we approaching this from a short-term perspective or a long-term perspective? If it's a long-term perspective, we'll look for longer-term financing, fixed rate, longer period of interest-only payments, and much longer-term business plan. Most of what we have done historically is value add acquisitions, which tend to mean that we need the kind of capital that will allow us to purchase a property, make the improvements to the property managerially and physically, implement our business plan, which typically means increasing our rents to make them compatible with what market rents are, and rationalizing expenses so that our expense structure reflects the market expense structure. And then we have the business that we want to have. And so often we will look towards less permanent capital for that purpose. And so, in addition to providing agency financing, Josh's firm is also able to provide bridge financing. And for the value add deals that we tend to do, that bridge financing is an important part of the equation, or the bridge to agency approach.
So what are you sending to Josh? Because if you're interested, let's say in deal X or something, what kind of information are you providing Josh with?
So in the case of most of the deals that we do, they're marketed deals or semi-marketed deals. So we'll have an offering memorandum from the owner or for the owner's broker. We'll send that to Josh. We'll send a market report that we've generated on the neighborhood and the sub-marketplace in which we intend to buy the asset, and we'll send him our underwriting model, which is essentially shows him what the historical income and expenses have been at the property, as well as our expectation for what the future income and expenses will be based on our management as opposed to the prior management.
And are you sending him a model that you think is accurate at the time, or are you sort of padding it a little bit, realizing that he might want to negotiate it down a little bit, so you want to leave some room in there? Or are you sending him exactly what you think the market, should be for this?
I mean, underwriting is a work in progress kind of an approach, right? So we send Josh our initial underwriting and what we think is accurate at the time.
Okay.
That underwriting will include, again, the historical income and expenses, what we expect to generate in the future, as well as what we believe the capital is that is required to get that asset to the point at which it's optimized. Okay. Josh will take that, and his firm will take their own look at that, right? And they have to think about things not from our perspective,
right,
but from their perspective as lenders that need to be comfortable that we are approaching it as conservatively as possible, that we have reasonable underwriting assumptions, and that especially if it's a bridge deal, that it's something that in the end Fannie Mae or Freddie Mac will take out so that we can have a permanent financial structure in place. So there's a lot of considerations on his side that we don't necessarily factor into our analysis. We just look at this as okay, here's what we believe the next 10 years look like. Here's how much capital we want to invest in the property. Here's how much it's going to cost us to buy it. And then we put it in front of Josh and have him come back to us with financing options.
Great. So Josh, now you've received this information from Dan. Are you taking what he says on full value, or not just Dan, but any of the people you get? What's your next steps from your perspective?
Josh just believes everything I tell him.
I just send Dan a blank check. I mean, that's really what it comes down to. Okay. But until I send him the blank check, no, what it comes down to is it's aligning the goals. And part of, having a trusted partner is sort of having and reviewing underwriting that is prudent and makes sense. So if Dan and his team are looking at a transaction, and like you referenced, most of our portfolio with them is with Corridor has been value add with obviously with some just straight permanent finance deals, but especially with the value add approach to a lot of their transactions, because we have a strong partnership and really with any borrower, but especially with Corridor, and that's why the trust and relationship play such an important part of the deal process and the overall efficiency, and especially in an acquisition where almost all deals are time sensitive, is that we'll get their underwriting model. We, again, as Dan referenced, we do have our own considerations depending on whether it's a bridge loan, whether it's a permanent loan day one, and if it is a bridge loan, how are the agencies or HUD or whoever or whatever the takeout is going to be, because that's our consideration. Is we, being a bridge to agency lender, we have to bridge that deal to something in order for it to be a feasible solution on our end. So we're looking at not just Dan and his team's initial underwriting, but also their pro forma and how that best aligns with one of our potential takeout solutions, whether it be a Fannie Mae, Freddie Mac, or an FHA deal. So we'll take Dan's model that we'll get from his team, and we then put all of that data into our model. And the nice thing about working with a group like Corridor is that we've done enough business with them, and they sort of understand what we're looking for, and then we sort of take their assumptions and their due diligence, to your question, Jeremy, at face value, because they've put some thought into their assumptions. We then align them with our criteria for not just a bridge loan if it's a value add, but also, like I said, the takeout, and we come up with a solution and say, okay, well, and it's an iterative process, but because we have that trust, the underwriting process becomes a lot less iterative, because we'll take the assumptions the Corridor is making, put them into our model, and ultimately, come up and fine tune a solution that works. And maybe there is some back and forth on some of the line items, whether they're, income assumptions, expense assumptions, but we take all the hard work that Dan and his team have put into it, and then piggyback off of that with our underwriting team to ultimately come up with a solution that, in terms of structure, in terms of pricing, in terms of ultimate immediate execution for the value add, but more importantly, the takeout for once they've executed the first phase of their business plan, all come together and create a solution that makes sense. Most importantly, for Dan and Corridor, but also gives our internal credit people the comfort level to know that not only do we have a solid bridge loan in place now, but we have a viable takeout, whatever that execution might be in 1, 2, or 3 years, depending on the Corridor business plan.
So are you negotiating both with Dan and with a lending committee on your end? Are you sort of in the middle here, in effect?
I am, yes. And so, and again, it all stems back to relationship, but because we have such a track record with Corridor, when we'll work with Dan and his team on the front end, but also we have either a loan committee, a true loan committee on the bridge transactions and the value add transactions, or a singular loan committee for Fannie Mae or Freddie Mac. So depending on the execution, it's almost a choose your own adventure. You have a loan committee for bridge, and then you have a singular credit officer who approves the Fannie Mae deals. And if it's a Freddie Mac deal, it's that same credit officer, but then it also gets reviewed and re-underwritten by Freddie Mac. So we are, my role is to sort of be the liaison and the relationship manager between Corridor and our internal credit team, and ultimately, Fannie and Freddie. But as the relationship has grown and evolved, and the partnership has evolved, Corridor has a stellar relationship with obviously not just the internal Lumet team, but also Fannie and Freddie, so that when they see a Corridor deal, they understand the sort of like the backstory behind it. There's been enough of a successful track record that absolutely plays a factor in the underwriting. Given the experience and the exposure we have to Corridor.
And do you sometimes come up with situations where you say, look, I've got nothing for you. We can't do this deal. Does that happen?
Never.
Or that...
No, it happens. I mean, there are some times where, because you also, it's rarely happened because of the due diligence that Corridor does on the front end. And it hasn't really happened too much with Corridor because their asks are all reasonable. We look at it more as fine tuning and sort of just aligning the goals. It doesn't really happen with a strong partner like Corridor because everyone understands the big picture going into it, and it's more a lot of the nuances of structuring the deal and finding the solution. But there are some deals where, especially in markets now, where as Dan also pointed out, that cap rate compression and certain deals just don't make sense. The nice thing is, Corridor does a lot of that vetting up front, so rarely will we see a deal that completely makes no sense because they never get to my desk because Dan's already vetted them and his team have vetted them through before. But I will say there are some brokers and some direct borrowers who just love an asset and are willing to pay a ridiculously low cap rate for it. But what they don't understand is, from a cash flow lending standpoint, they don't always make sense, or you're going to end up having to put a lot more equity in, day one, because there's just not enough cash flow to cover the loan to value or loan to cost on the purchase price. So, but it rarely, if ever, has happened with Corridor. But that's all a function of how strong Dan and his team are at identifying assets and understanding what ultimately works in the bridge space, but also in the agency space as well.
So if there's a line item that you don't necessarily agree with, let's say insurance or something, then what do you do? How does that work?
So basically,
your number doesn't fit with what your team comes up with.
Yeah. So the one thing that we have a lot of access to is we have access to our internal expense comps and rent comps, but also appraisal comps and most importantly the Fannie and Freddie portfolio. So we'll look at a deal in a market where where corridor is either buying or if they're going to refinance, and we'll help them with that. If they, are making some assumptions that may not be fully in line with the market, we will work with them to either, restructure their assumptions, or, if there's a justification, corridor runs very efficiently, and which is a testament to, again, to their, to their team that's in place and to their dedication. What we'll do is we'll then go back to an appraiser or go back and advocate on behalf of Fannie and Freddie. So say, for example, repairs and maintenance are, a certain number X per unit in the market, quote unquote, for an appraisal, and also in the Fannie and Freddie expense comps. If Coro is running that, or they can run it lower than market, and we're able to justify that and support that, we will advocate for that and ultimately underwrite to a lower expense line item number. And the ones that come to mind the most often are typically repair and maintenance, and payroll, and certain things are a little bit more what we call variable expenses, where there is a little bit more latitude on our underwriting. And so that's usually how we'll solve for that, with Dan and his team, is to just revisit some of these line items and find a number that works, that's ultimately supportable, both in the market, but also by Fannie and Freddie. And ultimately, Dan and his team, because they will go into markets where they have scale, they benefit from a lot of those operational efficiencies. And ultimately, the credit underwriting gives them the benefit of that due to all the scale that they have.
Great. Okay. So Dan, now let's say Josh has approved the loan. What happens at that point for you guys, for Corridor?
Well, when you say Josh has approved the loan, what happens process-wise is Josh gives an indication, of what loan pricing will look like, right? Which is literally subject to change just about up to the last minute until a deal closes. So we have to really keep our eyes on the market, and have an understanding that there is has to be some wiggle room in terms of what the final financing looks like. I mean, I've gotten calls from Josh almost the day before we locked the interest rate for a loan with something that changed. I don't know if you remember, Josh, but like 7 years ago, we did a deal where, you had to give me a choice as to when I would lock a loan, that day or the next day, based on some serious gyrations in interest rates that were occurring. I got a speeding ticket while we were having this discussion on my way to Vermont, and ultimately
remember that well.
Had to make a difficult decision because the financing markets changed. So it starts off with an indication of interest and a term sheet that Josh presents to us.
Okay.
And we look at that with some level of variability potential. We sign that term sheet up, and then we proceed down the path of doing due diligence that is both our due diligence and sort of verification due diligence on their end, which involves getting what's called a PCA done, which is a property condition assessment. We do an appraisal, we do an environmental assessment. All of those things affect the final pricing and the final approval that will have to come out of Josh's credit committee.
Now, one sec. So Josh, are you also doing due diligence at the same time on this, or are you relying on Dan's due diligence?
No, it's both. So it's kind of dual track. And again, it all comes back to the aligning of goals. So we'll take all the assumptions in underwriting that Dan, has given us up front, and we'll issue the application, go through underwriting, do all the third-party reporting, so that's kind of the concurrent due diligence. So we'll engage an appraiser to do an appraisal. We'll engage an engineer to do the physical condition assessment, property condition assessment, as well as an environmental study. All of that comes together during the underwriting process, in addition to all the due diligence that we're gathering from Dan and his team. That typically will take, probably 4 to 6 weeks. That whole underwriting process culminates in, and again, it's our due diligence in conjunction with Dan and Corridor's due diligence. And once all of that process, the culmination of that process is loan committee submission and ultimately approval. And then at that point, we'll issue a loan commitment, and the loan commitment will have the formal terms of the loan, interest, approximate interest rate. Obviously, it's subject to some volatility, like Dan mentioned, the speeding ticket scenario that we went through a few years ago. But it'll have the loan dollars, the proposed interest rate that's subject to fluctuate a little bit, obviously, the debt service, the loan to value, the reserves, all the major interest only, if applicable, any of the major, structural components to the loan. They'll then sign the commitment if they're agreeable to the terms. And at which point we are in a position to rate lock when obviously the borrower is ready and when the lender is ready. And then from that point, once the loan commitment has been executed and the rate is locked, usually closing occurs 2 to 3 days after. So all of that due diligence that's come in from Dan and his team, the third party report review and our assessment and analysis of that due diligence ends up in the form of a loan commitment and ultimately closing within probably 6 weeks after the first application has been issued and in the iterations of the underwriting process.
So Dan, let's go back to you now. I interrupted you before. You were in the process of discussing.
So one of the interesting things that can happen over the course of a deal, from the signing of a term sheet to the closing of a deal, is, like I said, things can change based on various factors. Our process internally is to raise capital from our investors, raise equity capital, knowing in the back of our mind that those changes could occur. Let's say we were doing a $20 million deal and we're requesting $14 million in financing, and Josh has written a $14 million term sheet for financing. We will look at that deal from the perspective that maybe that $14 million doesn't fully materialize. We want to be able to like that deal, whether that number is 13 million or 14.5 million, all of which is possible, right? Josh could call us back on the few days before closing and basically say, look, this thing appraised higher than we expected. It underwrote better than we expected. We can actually give you $14.5 million. We may say, great, we'll take the $14.5 million, or we may say that's too much leverage. We don't want that. If he says 13 million, we know that we're going to be in a position where we still want to do that deal. If he says it's $13 million, and we look at that then as just a more conservative capital structure. And, we also do need to think about, since it is a more conservative capital structure, but there is less leverage and therefore potentially lower returns, what's our plan for making up the difference that we may have lost from building a more conservative capital structure into the mix? So we're thinking about those things as we're refining our underwriting during the interim period between the signing of a term sheet and the finalization of a deal. Because our perspective is, once we sign that term sheet, unless something proves out in due diligence to be materially outside of the realm of what we expect, we are going to move forward and close that deal. So we have walked away from deals before and lost our deposits during due diligence, and we're willing to do that if something materially changes. But if something changes from a financing perspective only, we're always prepared for that to happen.
Got it. Okay. So let's suppose the deal has now closed. We're sort of post-acquisition. What type of relationship, what's going on now? Let's start at year end. Dan, what are you expecting of Josh? Then I'll ask you, Josh, what you're expecting of Dan at that point, post-acquisition.
Post-acquisition, the day-to-day relationship between Lument, for example, and Corridor ends up in the hands of our asset management team and our finance team. We have certain obligations that, is written into our loan agreements and contracts, that we've got to provide certain information to Lument according to certain timetables, and our asset management and finance teams have the job of doing that. They also interact where there may be a bridge loan where portion of the capital that we're going to be provided by Lument is based on the dollars that we expend, right? So there has to be an interaction between our asset management and finance team and their servicing group. Josh isn't really involved in that on a day-to-day basis either. Where Josh and I get involved is if something goes awry or off plan. So let's just say it's going to cost us more to enhance a property than we thought. We thought we were going to need, $2 million and we need $2.2 million. Or maybe there is something that's going wrong between our asset management team and their servicing team. Maybe there's something that needs to be changed in the way the capital is allocated. Any bunch of things. If some of those things change, Josh and I may have to be involved in coordinating the conversation between the various teams that have to make the decisions to tweak the financing, or to address things that are unforeseen. Now, for example, a few years ago, we did a loan on a property in Naples, Florida. And a year after we did the loan, there was a massive hurricane in Naples, and that then required a major insurance claim and almost a complete rehab of the property that we had purchased that was unanticipated. there was a tremendous amount of teamwork that needed to go into how we bring the capital in so that we could spend the capital that we needed to bring the property and Josh's collateral up to standard. And that tied into, the timing of when we were going to receive the insurance proceeds, which took about 1.5 years longer than was desirable by both parties. And so there was some complicated new stuff that we had to work on. And whenever there was a sort of a bump in the road, Josh and I got involved and made sure our teams were communicating effectively so that we could accomplish what we needed for our ownership and that they could accomplish what they needed to protect their collateral.
Okay, Josh, on your side, post-acquisition, what do your team, what's your perspective on it?
Yeah, I mean, Dan said it perfectly. I mean, I was actually going to reference the Naples deal because that's a perfect example of how we would stay involved post closing. The day-to-day operations post closing, as Dan mentioned, are typically run between our asset management folks and Dan's finance and asset management team. They have a great relationship. One thing that we have at Lumen is that Corridor is what we call a platinum client, which means they get little extra service and a little extra TLC as they should as a longtime partner, meaning that they have a dedicated asset manager for their deals, one asset manager for all their deals. It's a much more senior person that in a easier touch point for them to reach on a day-to-day level, whether it's a reimbursement request on a bridge loan or whether it's a question on insurance on a conventional loan. But I think where you really see and as Dan mentioned, we typically just monitor that again because we have asset management folks that, as Corridor being a platinum client, there should be and are getting that high level of service. And I mean, all of our asset management folks are very responsive, but the larger borrowers and the longer relationship partners, long-term partnership borrowers do get a higher designation within our asset management framework. But for example, on the property in Naples that had the massive hurricane, the insurance claim, it was complicated on all fronts. It was complicated because we have certain reps and warranties that we have to maintain within the Fannie Mae framework. And Dan, as he said, has his investor obligations to maintain too. When you have a major hurricane that blows through an entire property, it's most of that stems around insurance, but it's not just insurance. It's a lot of the capital work that went into it, and then that ties into insurance for getting insurance claims. And one of the structural components of a Fannie Mae loan is it's a little bit bureaucratic. And what I do to get involved with Dan is to break down some of that bureaucracy and make it as seamless as possible for Dan and his asset management team to get the reimbursements and to get the funds and to get the work done in a timely, efficient, quick manner, but also satisfying the requirements and the pretty strict requirements that Fannie Mae has. And so when we get involved with that, it was a perfect example of us working in lockstep to, and again, there's bumps on that with a situation like that because of the magnitude of the scope of the work project that had to get done. But we got there, and with, thanks to Dan and his team working with, me and my team all, collaboratively together with our asset management folks. Without that whole team working, it would have been a much longer process, and we were able to get a favorable and amenable end result for everyone involved. Most importantly, the Corridor team, but also satisfying the Fannie Mae requirements with as minimal hardship as possible. For Dan and the Corridor team, considering a hurricane completely ravaged one of their properties.
Terrific. Okay, I think we've covered everything. We started with building the relationship and then the deal itself and post-acquisition. Thanks, Dan, and thanks, Josh, for your insights today. I've been speaking with Dan Joseph, the president and one of the two owners of Corridor Ventures, and Josh Messier, who is managing director at Lumen. If you have any questions about what we talked about today, please reach out.